Good afternoon, everyone, and thank you for joining us for today's COVID-19 Quick Hits webcast. Today we have Todd Bulot and Lal Etcherhoff presenting on some information about investing post-election. They'll give us some information about what the market's looking like with the election outcome. So before we get started, I just want to give you a couple of tips on using GoToWebinar if you haven't before. You can submit questions on the side of your screen. There is a little icon that looks like a chat bubble. You can click on that to submit questions. All attendees and anyone who registered will receive a recording of today's webinar within 24 hours of the conclusion of the broadcast. And then lastly, for this short presentation, we will not be providing CPE or a copy of the slides, but like I said, you will get that recording if you need to reference back to it. So without further ado, I will hand it off to Todd and Lau.
Great. Thank you so much, Mary Allison. Appreciate that introduction. Well, good afternoon, folks, and welcome to the Quick Hits call today. On behalf of myself and my colleague here, Lal Etcherhoff, we are happy to be with you here today to share with you some information about the markets, in particular, some of the different implications from a macro perspective. But we're really going to drill down today to touch on the political implications affecting the markets. Certainly, there's a lot of information out there and lots of things that we could potentially cover. But we're just going to focus today our conversation on the implications of the election. Certainly there's still some outcome yet to be determined, but we'll give you our insight relative to the markets and how we're viewing those implications. So from an agenda perspective, what I thought we would do first is just briefly cover Level 4 capital management, just to let you know who we are, how we fit into the Carr, and Ingram family. And then we'll begin to address the markets post-election, and of course provide some outlook relative to the thinking of our group. So let me start by giving you some background information on Level 4 Capital. Again, I don't want this to be a commercial, but just wanted to set the stage to provide insight and context into how we go about managing assets on behalf of clients. So Level 4 Capital is a registered investment advisor. We are part of the Level 4 Group, which is a subsidiary of the Carr and Ingram company. Our goal as an entity is to build customized investment portfolios on behalf of our investor clients. We have clients ranging from $50,000 retirement accounts to ultra high net worth $50 million relationships. So how we go about building portfolios really depends on what that client relationship looks like. But in all cases, we adhere to a consultative approach, understanding what the investor client is trying to achieve from a goals and objectives standpoint, and then ultimately constructing a holistic investment plan or investment portfolio around understanding of those goals and objectives. How we go about doing that is through an institutionalized investment process. Now, in light of the limited time that we have with you today, certainly there are a number of different investments that we could potentially put into a portfolio, ranging from equities to fixed income. We're going to place most of our emphasis today on the equity side of the equation here, again, just out of essence of time. But I wanted to give you some brief information relative to the process behind how we go about building the portfolios. And it is this process which is at the heart of what we do. And we're going to get into that a little bit more as we get into the implications that I referenced earlier. But the process, we wanted to just give you a sense of what we do. So we begin with quantitative analysis, using computerized screening models to help identify potential companies for inclusion in our portfolio. And then really drilling down into the fundamentals of those companies via fundamental analysis. That's really at the heart of what we do. It is an institutional, repeatable, disciplined process, and it drives everything that we do at Level 4 Capital Management from the equity standpoint. Now, the output of that will be stylistically pure portfolios, ranging from large cap growth through small mid cap growth from the equity perspective, as well as I said earlier, lots of different solutions that we could potentially put into a client portfolio, including fixed income strategies, as well as more traditional asset allocation models. So a range of solutions, but again, we're going to focus our comments today primarily on that equity process and how we go about understanding macro themes and how they apply to bring together that process to identify potential candidates for inclusion in a portfolio. So let's shift gears, if you don't mind, and kind of start to drill down into what those macro themes look like, and in particular, address the election implications. Now, there's a lot of information that we could potentially cover here today. Obviously, there's the ongoing COVID-19 crisis domestically as well as globally. Probably don't need to, ask out too much more of that. Suffice to say that we hope the light is at the end of the proverbial tunnel and we're making our way through that crisis. But of course, we are still dealing with the fallout from a global recession as a result of COVID-19. And then, of course, here domestically as well as globally, we are dealing with or focusing and paying attention to the amount of Fed policy and stimulus that is really keeping things afloat right now. And we can get into that a little bit more as we begin to discuss some of those implications. But again, what we're going to focus on today is really that 2020 U.S. presidential and congressional elections and the implications of that election. Now, as I referenced earlier, so there's still some uncertainty as it relates to the election. We have a presumptive president with President Joe Biden, President-elect Joe Biden in the White House. But certainly we still have some clarity that is yet to be determined from the Georgia Senate race, which will determine what the ultimate makeup of the Senate looks like. And if we're going to look at a more blue wave scenario in Washington, D.C., or if we're going to have a divided White House and Congress. That's yet to be told. But let's just focus on what we do know and what we can focus on right now, and that's the data behind, the election results. So I don't want to come off cavalier and say we don't care about who's in the White House, but what we are going to do is focus on the data behind answering that question: does political party matter? And so while we, want to focus on and pay attention to what's taking place from a political standpoint, there's some numbers behind that question: does political party matter from a historical standpoint? And I guess I should say at the very outset, this is a politically agnostic presentation here. As an investment advisor, as a money manager, we have to be prepared to manage assets irrespective of who is in that White House. And so we position our portfolios as such, relying upon the data, relying upon the science and the process behind identifying those companies. So suffice it to say, if we look at that question, does political party matter, there's a number of ways we could look at it. First piece of information that we have to share with you here is taking a look at the annualized S&P total returns by administration from a historical standpoint. And you'll see from the far right of the page, we have the Trump administration, and this is, of course, just through August. So these numbers within the Trump column there would be a little bit different. But you could see back historically through the Truman administration, the numbers are in a fairly, consistent range from a return standpoint. Some a little higher than others, but pretty consistent across the board, with the exception there of, you'll see, the Nixon and George W. Bush administration. We look at things a slightly different way, but again, continuing with that theme of does political party matter, let's look at the hypothetical growth of a dollar as it relates to market and different administrations. This chart actually goes back a bit further, back to 1933, and looks at, you could see there the blue and the red bars within that climbing growth chart there, the Democratic and Republican presidential cycles. I think the takeaway here is that it doesn't matter who's in the White House, right? You see that the market is going to do what the market's going to do, and it does have that consistent climb north. Now, certainly there are peaks and valleys within that growth trajectory. It's not a flat line. That's normal. We do expect to see volatility within the market. I think every investor should be comfortable with that notion. But again, suffice it to say that does political party matter? If you look at this chart, I think everyone would come away from the conversation saying, likely it does impose a whole lot of influence. We all, of course, have our own individual beliefs, but the market's going to respond as it always has, in our view. Let's take that one step further. Certainly we have, different scenarios as we look at Washington, D.C., not only who's in the White House, but who controls Congress. So this data point here, our graph, goes back to 1789 and really gets into the heart of, who's in the White House, as well as, what does the scenario look like on the Hill from a Democratic, sweep or control of the House and Senate to Republican or some sort of divided scenario. So what you're looking at here, again, going back into 1789, you'll see the different administrations or the different, makeups of within Washington. And you'll see there that everything is in a pretty narrow and consistent range. From the early stages of an administration, everything tends to move really on a sideways basis for that first 18 up to 24 months. But then you'll see as things begin to gel within that administration's policies and from a regulatory environment perhaps, you'll see that things tend to begin to escalate or go higher. So does political party matter? I hope that some of that information gives you some insight into how we approach the topic, that we take that politically agnostic view, but from our perspective, it doesn't matter who's in the White House. And I think history can give us some indication of that. Now, we do have some further statistics that my colleague is going to cover with you to give you some further insight into that concept.
Hey, thanks, Todd. Lau here. So adding to the evidence, I saw a recent study Dr. Ed Yardini has done right before the election, the most recent election. And he went back to FDR and basically looked at the performance of the S&P 500 under divided or unified government. Once again, similar to the study on this chart, but the hard and fast numbers he found is there were 6 blue waves, again, going back to FDR. The average return for the S&P was 56%, 3 red waves, which was 35% on average, and a unified government average of about 49 or 50%. And 7 periods of divided government where you had a 60% return on average. So that's a pretty significant difference in returns on unified and divided government. So why is this important? We've kind of beat a dead horse on this subject, but it is very important because we'll talk more on this lately as far as, okay, then what is important? Also remembering that 40% of our GDP, which is a measurement, the way we measure the output of our government, is government spending. So we'll talk more on that later. So I think the reality is jobs are created by businesses, not politicians. That's kind of going to be the point here.
Excellent. Thank you, Lau. So let's shift gears once again as we continue through the presentation and talk about more in depth those election implications that Lau began to allude to. I wanted to just sort of recap, we talked about the process because I said we wanted to kind of bring this full circle to talk about it and bring it more from a focused standpoint. So I spoke about that quantitative and fundamental process. So let's really take that fundamental portion of the process and drill down into it, because this is where we begin to see some of the differentiation and some of the nuances of what we're paying attention to from an investment process standpoint and how we go about identifying companies for inclusion in a portfolio, and maybe where some of those implications really do come into play.
Thanks, Todd. Once again, and so at level 4, I'm responsible for the equity portfolio management, and the way we use a bottom-up process. And so we believe that the value of any asset, and especially a share of stock or the value of a share of stock or any asset is the intrinsic value of that asset. And the intrinsic value is the present value of the future cash flows that asset generates. And so this is just a real big overview of how we calculate that cash flow that the assets of the firm generate. And so on the next slide, you can see we go into how these different factors are affected by or potentially affected by a Biden win or a Democrat sweep or things like that. And so I think the point is overall is the president isn't as important as the monetary and fiscal policy. So we're looking at a historical amount of government stimulus and spending. That's going to affect that top line or that revenue number. You see the first little American flag logo. And so we'd expect that to go up. And that's probably why, again, not being political at all, but if you look at the numbers under a blue wave, it's higher, probably because government spending is a very large part of GDP, and that's going to affect and probably stimulate a little bit more growth over, especially a short period of time. Now, if you go to the next, the blue arrow that points down on there, we know that corporate taxes are probably going up. Biden stated he wants to raise corporate taxes back from 21 to 28%. So we've been there before. That doesn't scare us that much because we think there's going to be somewhat of an offset from that increased stimulus and spending there. And also, when we go and we run valuation on companies right now, we're using the higher tax rate anyway, just to be conservative. The other thing from the government stimulus and checks that businesses are going to get, they could get extra cash there at the bottom and lead to excess cash and therefore higher valuations.
So I think that's a good overview, Lau, as it relates to valuing a company. Certainly there is, again, lots of headline noise, if you will, within the market. But at the end of the day, if you're valuing a company appropriately, using the data, using the numbers, it's going to lead you in the right direction from our perspective. So I guess that maybe the next logical step within this presentation is to answer this next question. Is the market overvalued? Where are we today? We certainly have gone through the election. We have a presumptive president-elect in the White House. As we said earlier, we still have some clarity to be had or determined within the Senate race. That will be determined in early January, hopefully. But where do investors go now and in the foreseeable future to if they're interested in investing in the market? There's a lot of headlines now that the market has come very far in a very fast order, as we've come out of COVID-19, saying that maybe company valuations are overvalued. They're a bit too rich. So let's get into that question. Is the market overvalued? And give some insight from a more macro perspective relative to the market, what you're focusing on, what we're seeing within the overall dynamic of investing in the market.
Okay, Todd, thanks. Once again, I think you've probably heard the quote. I think it's from Warren Buffett, price is what you pay and value is what you get. So we always want to be focused on the difference in price and value when we're talking about any kind of financial asset, and especially equities. If you watch any kind of financial news network, they tend to focus on price. If you start looking for that, you'll notice there's not a lot of talk about value. There's a lot of talk about price. But I'm going to talk about price now because from short-term basis, I do think we're a little bit over our skis on the market. One of the few things we look at from a short-term or technical basis is this put-call ratio. And you can see, back in the last peak early in the year, if you look at that red line where it's way above the green line there, where the yellow arrow is, the market, it went way up when the market was way down in March, and vice versa. The lower number shows that there's way too much bearishness out there. It's what we call a contrary indicator. And so we're in that low area right now, which means we're probably kind of starting to run out of buyers. And so, somewhat a concern for a short-term basis. Now, this can go on for quite some time. So we're not sitting here and we're a bottom-up investor, so we don't really make market calls. But we definitely see things out there that make us more cautious or more conservative when we're estimating what's going on with individual companies. Another thing we like to look at is the number of stocks above their 200-day moving average. So stocks that are above their 200-day moving average just means that you have a very high percentage. In this case, almost 93% of the stocks on the S&P 500 are above their 200-day moving average. And this is a really good measure, much like the put-call ratio that works at extremes. It doesn't tell you a lot at the middle, but when you get an extreme number, either that below 20% or above 80%, that's somewhat of a red flag. So we do think from a price perspective, over the next few months, there's a little bit more risk. But keep in mind, a normal correction in any year, intra-year, is 14% in any year. So that just means whether we have a good year or a bad year in the market, it's normal to have a 10 to 15% correction in that year. A lot of times we don't notice it if we close up 30% for the year, but it happens. So, we're talking about that kind of normal correction that could happen when the market just takes a breather. Now let's talk about what's more near and dear to my heart, and what's, I think, more important is market valuation. You've probably heard a lot of people when they're talking about price and how good the market's done lately, and the Dow's at 30,000, and that seems risky, but not so much when we look at the valuation. If you look at the first big circle back in 99, 2000, what this is a chart of the much how we would model the valuation of the overall market when we're looking at it. It's taking the S&P earnings and it's discounting those earnings, the cash flow, at the average of the corporate bond yields out there. So there's a little bit of a risk premium in there, unlike just using government bonds. So it gives us, again, a pretty conservative estimate of where we should be on the S&P valuation-wise. And you can see in 1999, we got just about 100% overvalued based on the cash flows that the companies of the S&P 500 were generating. Right now, we're almost, we're about 42 to 45% undervalued based on the cash flows. And keep in mind, the reason we use this when we value companies or when we're looking at a market is these are real numbers. When you look at cash flow, when you look at assets, these are numbers that actually exist. They're not accounting numbers. And we like that. We think it's the best way to value just about anything in there. So, this isn't another 1999 at this point, although we do have a bifurcated market where you have pockets that are probably way overvalued, and we have pockets that are way undervalued, and everything in the middle. We think this plays into our hand as a manager in the way we build portfolios.
Excellent. Thank you, Lau. Appreciate that perspective. So folks, we're about 22 minutes into our presentation. In consideration of time, I wanted to just start to wrap things up, if you don't mind. So next steps for investors. What we've tried to do is paint a picture of, addressing that question of political implications. Does party matter? Hopefully you've taken away that from our perspective and our opinion that it does not. It's certainly something that we pay attention to, but it's not going to influence the day-to-day operation of the portfolio from a portfolio management perspective. And then some insight into where we stand from a valuation standpoint in relation to the market. Certainly every individual investor is unique within their investment objectives, but next steps from a next steps perspective, certainly we adhere to the mantra of the best plan is to stick to a plan. Talk to your financial advisor. If you have questions, we're certainly able to engage with you as well. But ensure that your investment policy or plan is updated with your current allocation and it's in alignment with those long-term goals. As we've seen from the 2020 year, volatility is certainly something that is a normal part of the market, and we should assume that we will have that on a go-forward basis. As Lau said, we may look to have a 10 to 14% correction on an annual basis. So having a long-term plan in place, of course, is critical to ensuring that your goals are achieved in the long term. So I will leave you with some information about Level 4 Capital. Certainly, if you have additional questions or you want to find some additional information about our firm, our insight, our commentary on the market, please look at our website, level4capital.com. I could also encourage you to reach out to your Carr and Ingram representative, and they certainly can put you in touch with us at any time. But as we approach the holiday season, I wish you well, be happy, be healthy. And at this time, I think we will look to see if there are any questions and answer those that we have.
All right. We haven't had any questions come in so far, but if anyone has a question, we will give you just another moment or so to type that out and get it submitted so that we can address it. Okay, looks like we don't have any incoming questions. Like Todd mentioned, you can reach out to Level 4 Capital Management or your CRI advisor. There was one question that just came in as I was saying that, Todd. Did that show up?
Can you just go ahead and read that for me, Mary Allison? I'm having trouble getting it open.
Yeah, no problem. The question is, I noticed in the stock versus bond valuation graph, the 2008 crisis doesn't stick out. Any comments?
Okay, bear with us. We're just going to go back to that chart.
Well, I think it sticks out as being undervalued, not as undervalued as we are now. But remember, it's a function of a couple things here. So what usually happens we don't have recessions marked up here, but what usually happens during a recession is earnings and earnings estimates go way down, and so that's a moving target. So I think what happens is that's different in every recession. The 08 recession or the financial crisis in 08 was different than most other crises we've seen in the past. It was caused by financial institution stress and too much debt. So unlike other recessions that were more cyclical in nature. And so you had, it was faster because of that. And I think that, every one of them's a little different. But one thing I would point out there is in the bottom of, it kind of showed you the same type of undervaluation that we're seeing right now. And the market's at highs now versus then. The market went down, of course, people that experienced it, most people, it was not a good experience. We were down about 50% at the low at one point, and closed down about 37, 38% for a year, if I remember correctly, on S&P. So I hope that answers your question.
All right. So thank you, Todd and Lau, for this presentation. And thank you to everyone else who joined us today. Just as a reminder, there will be a recording sent out within the next 24 hours. And I hope everyone has a great holiday season and a Happy New Year.
Thank you, Mary Allison, and thank you all.
Thanks.